The energy crunch hitting Europe make it worse as China is telling its companies to secure energy supplies at any cost. And in the U.S., fears that a cold winter could limit supply here as well are sinking in. Oil is rising today, though off highs for the week. Natural gas down about 3%, still around $5.60. But look at the moves we've seen in September. WTI West Texas crude jumping 10%. Brent up 8%. Natural gas up 34% in just a month. And now there are calls for the U.S. to cut off exports and ensure supplies at home. Francisco Blanch says oil could top 100 a barrel in the coming months. He's Bank of America Global Research Head of Global Commodities. Francisco, welcome back. You're talking Brent, right? But WTI probably wouldn't be far behind.
Yeah, that's right, Kelly. Thank you for having me. I think WTI will probably be a couple dollars behind that call. And remember that we are at a unique point in time now where just all energy prices are going up. As you pointed out, it's global gas heading into China. We're seeing a tremendous amount of demand for liquid natural gas there. We're seeing European gas prices following right behind the Chinese prices. And then, of course, the U.S. markets also started to tighten on the back of this extraordinary global conditions that we have here.
I don't want to overly connect the dots, but I wonder if this is partly why airline stocks have been underperforming. Obviously this would be a big input for them. But let's talk more broadly. You are warning that this oil crisis could cause something like we saw in the 70s or like we saw just before the financial crisis hit. Do you think people are focused enough on the effects it's going to have here? Or if I were to take sort of the optimistic case, maybe it's just, gasoline's a little more expensive. Your heating bills go up 10%, but it's not the end of the world. What's the likely outcome here?
Well, look, I think what you can say is at the very least, the U.S. is much more insulated from these global energy trends than the rest of the world. As we just pointed out, China, Europe are paying $30 per MMBTU for natural gas. In the U.S., gas prices are $5, maybe $6 per MMBTU, right? So you have prices are a fraction there of what you're seeing on a global scale. But the oil market is indeed global. Now, the benefit to the U.S. is that obviously the U.S. actually has a lot of domestic oil production. So I do think that the spike, if it does indeed happen, will be less detrimental to the U.S. economy. But on a global basis, it could be very complicated because remember, U.S. inflation is 5% already, right? German inflation hit 4.1% in September. So we have central banks telling us that inflation is going to go down in the next few months. If we have a cold winter, oil prices are going to rise with gas, and it will be really hard to bring inflation down. What do you tell the market if you're Powell, if you're Christine Lagarde? Can you keep telling them this is a transitory situation when we know supply chains are broken around the world, when we know that there is all kinds of issues moving goods around the planet, there are shortages of labor in different pockets of the economy? Can we really keep sending that message if energy prices go up 20, 30% from the current levels? I highly doubt it.
So I think that warning is pretty clear as it is. So let me just ask you about the energy price piece of this. If things really go parabolic, they will eventually collapse, won't they? Or do you think this is some kind of permanently higher plateau?
Well, I think eventually, yes. So I think we have a winter weather spike. You're going to hurt segments of industrial activity. We've already seen some UK industrial players shutting down activity. We've seen also similar impact in Europe. But as you pointed out in the beginning of the program, the Chinese government is telling companies to essentially secure energy supplies at any cost. To me, this is all concerning because remember, we have issued monetary and fiscal policy like never before. Remember, monetary policy, the monetary policy expansion is 3.3 times what we saw in the financial crisis for COVID. And the fiscal policy is 4.5 times. So we've sent out this enormous amount of money into the world. And now we're wondering, why are prices rising? Right. Supply chains were broken to begin with. And we have this enormous amount of fiscal and monetary policy floating around. So my concern is that we end up triggering something a little more complicated here that's hard to stop, given where we are in the inventory cycle. Inventories are just low, Kelly.
Explain that very quickly, if you can. In other words, because of all this extra cash that's causing demand way outstripping supply, when you say things could get a little more unusual, does that mean we could see much more extreme spikes to the upside before this is over?
I think there's a risk of that. And obviously, remember, neither Saudi Arabia nor Russia are particularly interested in solving an energy crisis that they don't feel they have created. Because a lot of the energy crisis we're facing today is somewhat connected to the green policies we've been pursuing by limiting our coal-fired generation, by limiting our nuclear power generation in different parts of the world, and oil fire generation, and just generally oil usage. So we are kind of putting this straitjacket around the economy globally, and then we inject all this money, and then prices just get out of whack, and we are surprised. Maybe we shouldn't be. And I think ultimately, the macro risks, I think, will continue to build, and inflation, of course, is always going to be the biggest challenge for central banks, and frankly, for equity and bond investors to deal with here.
Shepard Smith here. Thanks for watching CNBC on YouTube.